Jeff, good to see you, my friend.
Likewise. How you doing?
Yeah, I'm good actually. As we spoke about before, trying to make sense of this crazy world. Hey, you've been on Real Vision a number of times, but just for people who haven't gotten to know you yet, just give a little bit about what you do and a bit of your background and your journey into crypto, just because it always anchors it for people and people get a good understanding of how you think.
Yeah, absolutely. And first, thanks for having me back. So I'm Jeff Dorman. I'm the Chief Investment Officer at Arca. Arca is a full service asset management firm with offices now mostly in Los Angeles and New York, but around the world. We cater to all different facets of the digital asset market. We've got five different fund strategies right now, from liquid, directional, research-based digital asset fund strategies to market neutral yield strategies to private venture and even sort of niche NFT funds. But we've grown, entirely in the digital asset space now for the last 5 years. And before that, I was a TradFi guy, investment banker at Lehman Brothers, bond trader at Merrill Lynch, worked at Citadel and some other equity and debt funds. So really spent the first, 15, 20 years of my career looking at the same factors that are now driving digital assets. So I thought I had escaped, but I'm getting sucked right back in.
How did you, give me your crypto journey and why you end up sort of setting up Arca, because you were pretty early in setting up a crypto hedge fund. So I'd love to hear that process.
Yeah, sure. Yeah, I mean, honestly, my journey is probably very similar to a lot of people, only maybe a few years earlier. In that, the first time I heard about Bitcoin, I laughed and dismissed it and thought it was a joke. It was 3 years after the first time I heard about it that I actually invested in it. So I think, similar journey. At first, I was like, that makes no sense. That's crazy. Then a few years later, it was like, actually, maybe it's not so crazy. Maybe I'll put a little bit of my own money into it. And then a few years later, it was like, actually, the rest of the world is crazy. This makes all the sense in the world. And but I think for me, starting Arca was really when I moved away from Bitcoin and started to see what the rest of the world, how the rest of the world could be affected by blockchain technology and digital assets. And it doesn't mean I'm not still bullish on Bitcoin. I certainly am. But to me, Bitcoin wasn't a career. Bitcoin was like a hobby, whereas the rest of the digital asset world is more of a career. Because in my opinion, I think digital assets are the greatest capital formation, customer bootstrapping, and stakeholder alignment tool that we've ever seen. And it really, in my opinion, kind of throws on its head what the meaning of equity is and what the meaning of debt is. And, I really believe in a world where digital assets aren't even an asset class. It's really just the technology that's going to underpin all asset classes. So you already had currencies with Bitcoin, but you're ultimately going to have your equity tokens, your debt tokens, your commodity tokens, your real estate tokens, your data tokens. I think everything is ultimately going to be encompassed with blockchain and a token, and that's the world we're headed towards. So when we set up Arca, it was to capitalize on just that, right? We wanted to give investors the exposure to the growth of the price action of some of these tokens, but we also wanted to build products that utilize the technology in the same way that the ETF turned the 4 p.m. mutual fund on its head. We think digital assets are going to turn ETFs on their head and ultimately be the way every single investor in the world holds assets.
What year did you start Arca?
Officially 2018. I think we put the building blocks in place in 2017, but we launched our first fund in 2018.
So you launched straight into a bear market.
Yeah.
How did that feel? Talk me through that, because obviously we're all made from our experiences, so we kind of understand
Sure.
the context of the world often from how we first started in markets. So you launched straight into a bear market. What the hell do you do?
Yeah, it's a great question. There's a couple of things, right? So first and foremost, it was a great time to learn. Now we're all working 24/7, and the amount of investor interest and media interest, it's nonstop. Whereas in 2018, you could just read and talk to people and really kind of come up with your valuation techniques that you're going to use in this market. So when we first entered the market, there was really only three kinds of investors. You had your Bitcoin only investors, who some of them have evolved, some of them are still Bitcoin only investors, but largely either macro investors or they're government libertarians, right? Who just want to completely free themselves of government anarchy. Then you had your quantitative algo, systematic type funds who were certainly taking advantage of the vol and the correlations, but maybe weren't really that interested or focused on what these assets really were and how to value them, which is why the majority of those funds still focus on the 2017 legacy crop of your, Bitcoins, Bitcoin Cash, Litecoins, Ripples, things like that. And then you had your venture investors who, were probably the most forward-looking in terms of understanding where else this technology could be applied. But in our opinion, they weren't taking advantage of the liquidity and the nuances of digital assets, meaning, they weren't looking at things like tokenomics or, what it means to have a token backed by assets or, all the different, characteristics that now make this investment set so unique. The venture playbook was largely just spray and pray and put money into everything and see which ones grow and which ones don't, which is totally fine, but it just wasn't all encompassing of where we thought this was headed. So in 2018, with the bear market, we just started developing our own techniques, right? We started to look into what parts of the Graham and Dodd valuation can we apply to this investment set? What part of Frank Fabozzi fixed income Bible properties can we apply to digital assets, and where do we need new techniques, right? How do we account for things like supply sinks and amortizations and the utility function of these digital assets in addition to the financial function? So 2018 was really just a lot of learning, and it was, in retrospect, a great time to launch a fund, because we were able to just figure out exactly where we wanted to go as a firm, what kind of strategies we wanted to build, and how to speak the language to investors, so that when 2019, 2020, 2021 came along, we were miles ahead in terms of being able to have the operational infrastructure, the fiduciary capabilities, the reporting requirements to be able to take in institutional money, and like most in this industry, we've exploded in terms of assets. But more importantly, I think we've exploded in terms of education and helping the masses learn about what this industry really is.
And so your model for the main fund is really interesting. As you said, you tend to use a different type of valuation tool than most people look at. A lot of people had no valuation tool and were just using technical analysis. Others, like myself, I tend to use more Metcalfe's law style analysis, network growth models. But you looked at bottoms up because I think you started in a bear market. So then what you're trying to find out is what you can buy that's less risky. So my guess is that applies now at this point in the cycle as well, where we've had this 1 year huge range with kind of declining interest in the space a little bit, somewhat. How are you using that framework now? And what are you uncovering? Is there value around yet, or still not there yet?
Yeah, there's definitely value. What there isn't is value investors, right? Value only has value if other people who look at it that way. What this space is missing is that growth equity investor or that long only mutual fund investor that, takes you from the early stage VC to the retail IPO, right? In the traditional debt and equity world, you have all these funds in the middle that sort of nurture the growth of public companies. We don't really have that yet in digital assets, right? You have these huge early stage VCs that are raising money hand over fist and throwing money at every private project they can, but they've got nowhere to go with that token once it goes public, other than retail and a few funds like us. So I think it's not that there's not value; it's just that there isn't a value investor. But the way we look at it is simply, first we had to define a taxonomy, right? That was the most important part of this journey. And we put together a nice infographic on our website and distributed it out. If anyone wants to see it, it's on our website at ar.ca. But first we had to define a taxonomy. And we think of it a lot like the fixed income world, right? The fixed income world has very different issuer types, right? From government, munis, corporates. It has very different bond ratings. It has very different types of tokens, from your callable bonds to puttables, convertibles, preferreds. You have different covenants within bonds. That's kind of how we had to map out the digital asset space, right? So first it was, who are the issuers? Well, the issuers can be governments like your CBDCs. It can be completely decentralized, organizations or DAOs. It can be an individual, right? Somebody who's just issuing a token on behalf of themselves or their own income. It can be a flat out corporation like a Binance or an FTX. So first it was, who are the issuers? Then it was, well, where do they fall on the spectrum from fully decentralized to centralized or anywhere in between? Then we had to figure out, well, what is the token type, right? Is it a currency, just a medium of exchange within a network? Or is it an asset-backed token, something like, whether it's a security token backed by real estate, or something like Nexus Mutual that's backed by the assets in the capital pool? And then, is it a pass-through token, something that has, hybrid qualities where it's quasi equity, quasi, membership or loyalty reward card, where it actually has some sort of pass-through characteristics. And we can get into that in a minute. And then it was, well, what are the actual features of the token, right? Does it have an inflation schedule or an amortization schedule? Does it have a dividend or a buyback feature? Once we define that taxonomy, then value investing is really easy, right? You look for those tokens that fit certain characteristics and certain properties. So for example, one of the analogies, we use with people all the time is imagine if Amazon Prime and Amazon shares were one buyable asset instead of the way it is right now. Right now, you could be an Amazon shareholder, or you could be an Amazon Prime member, but there's no reason you have to be both. A lot of people are both, but you don't have to be both. In the token world, you kind of have to be both, right? If you want to earn the upside of Amazon's growth through the shares, but you also want to be a member of the Amazon network and earn the free shipping, the Whole Foods discounts, the movies, the music. Well, now you can do both of those at the same time by having a token, right? The token might give you member benefit type privileges and discounts, but it'll also give you some form of financial upside through the form of a buyback or a dividend or something else, ascribed to the profits and growth of the business. So BNB is the perfect one to explain when we go to investors for the first time. We'll say, look what Binance did. Binance is a regular company. There's nothing centralized about them. They have debt, they have equity, they have a board of directors, they have a CEO. But they were one of the first to introduce one of these pass-through kind of hybrid tokens, right? The BNB token was issued with a fixed amount of tokens. They encouraged their customers to buy it. Their customers, if they owned the BNB token, got all kinds of member discounts. First, it was just a reduction of trading fees, but over time they added to it, just like Amazon Prime did. And over time, now they can a BNB owner could get they can use the BNB token for collateral to trade options and futures. They could use it to get first dibs on new tokens that Binance issues to their customers. You could even use it for discounts for travel around Asia. So just like Amazon Prime, Binance increased the utility benefits of owning the BNB token. But also on the financial side, just like Amazon shares, Binance said, we're going to take 20% of our profits and we're going to use it to buy back tokens in the open market. So there's your Graham and Dodd free cash flow modeling. You model the revenues and cash flows of the business, and you look at how that affects the Binance token from a free cash flow standpoint. But more importantly, what it does is, unlike Amazon, where you could be an Amazon Prime member and have no benefits at all if Amazon grows, or you can be an Amazon shareholder and do nothing to influence the growth of that company. If you're a BNB token holder, you're doing both, right? You become an evangelist overnight because you want every single person in the world to use Binance because you're getting paid through the BNB token if they do. So there's your stakeholder alignment. There's your customer bootstrapping. And I think that's the very reason why Binance is the fastest growing unicorn in history, going from nothing in 2018 to, a $300-400 billion enterprise value today. So that's what got excited to me in 2018. And that's what we look for today.
The cryptoverse is an incredibly exciting place, and it's going to be absolutely massive. This has been just a small taste of my own personal journey into crypto. Join me for free over on realvision.com/crypto as we discover just what this new world will look like and much more.